not recording.
Okay,
Okay,
thank you.
let it start. Sorry, because most of the times me for my calls, I always I don't record. I just forgot that I was doing my my other meetings. But it's fine. It's now being recorded for those who may probably want to go and revisit later on. Find the link after the meeting to go and just go through again. Because what I'm going to share is today is going to be amazing. I hope you just stick around. I finish my story just in the next 1 minute. So it's an experiential story though. 10K, initially before then, I had advised her, you know what, the best you can do is you engage in sports trading. There's a negativity that people have developed towards sports trading, but people do not know how amazing the sports market is, how safe the sports market is. Just that people sometimes tend to lack some of, some of a little bit of an ingredient on how to go about the sports market. But it's one of the amazing markets, honestly. And it's one of the market that you can trade in with so much peace of mind, and you can actually be very consistent in making profits in the sports market. If you have the capital, because normally there the capital is what matters. Now, even 1K is good. 1K is good, 2K is good, 3K is good in the sports market. But you just need a little ingredient. To me, I'm not degrading futures market. It's one of the amazing markets and people make a lot of money there. But also people lose the much they've made also just in a blink of an eye in the same market. You cannot really, the ratio of retaining what you make in the futures market, I would say almost is less than 20% for most traders. Most traders, even those who tend to show much share, they're screenshots of the profit made of the day. For as long as it is in the futures market, to me, I always find rest in believing that, what is the retention percentage? Yes, it is $200, but is it tangible? Is it visible? Is it what your heart can rest in? Are you sure that what you shared is exactly what is inside you? So it's different because sometimes we make so much, we begin developing some greed. We want to make so much because we're seeing it is really moving in our favor. We've made so you're like, let me make 100. Yeah, okay. Let me just add some $50, dollars. Before okay, let me just add some $10. Okay, let me just add, and you're just adding and adding and trading and trading and trading, thinking some people are not watching. The whales are funny. I'm building a background on something we're going to look at today. We're going to share on something that is going to give you an edge. It's going to give you something new to begin looking at when you're really dealing in these markets. Okay, so the whales will be watching keenly, following your footstep. What are you doing? Hey, it's a bait. It will be like a bait. You know how you catch a fish. Hey, you put a bait. Probably you may even put a big one. It will come and try to eat around before reaching the hook part. That part with the hook. In another time, think, okay, let me now swallow it because it thinks other fish or fishes will come and find when it has not yet finished its meal. So it wants to just grab everything and go and run. As you grab, thinking you're going to run, that is where the hook, gets you. Where are you going? So as you do this trading, do know that the futures market is full of traps. Yeah, it's amazing. It's beautiful if you understand the concepts of what we're going to share today, and then you understand that the market is moved by institutions or large orders or large, what we call them the whales. And as a retail trader, you tend to so much follow their footprint. You ride on their back, then you will now know that as you're approaching the market, you need to be absolutely observant and careful. And you will mind so much that even when you make only $10, you would rather keep the $10 instead of wanting to make $50. Then you make 40 By the time you want to make the 50, you again lose the 50 plus, plus a bit of the capital. So it's very important for you to really understand that. Okay? Okay? Yeah. So that said, ladies and gentlemen, how do you look at the futures market? And I'm going to share something because I'll be, let me just share my screen. You'll also kindly inform me in case I maybe go mute or probably become unheard, right? You will let me know so that we are really on the right track, okay? In case my network disturbs in a way and you can't hear me, please don't hesitate to let me know, okay? Yeah, don't hesitate to let me know. Yeah, so, just a minute, let me open. Let me try to share my screen. Oh, yeah. So I just get a lot of amazing experience from people when she come to my inbox. Anyway, I don't say it's bad to share experience or to share with me how the market is humbling you, but yeah, we need to learn from it. We need to really learn from it so that next time we are always we are not so so that we really know what we are doing. Okay. Okay, so okay. So ladies and gentlemen, I want us to first recall. Let's build from a small principle that we all must be conversant with. We know that these cryptocurrencies, actually all of them, tend to have fixed supply. Okay, so when you're trading in these markets, do know that we have specific quantity of coins that are available in the market, and it is the same coin with a specific or fixed quantity in the market is the same coin that probably all the different investors, retail traders, the institutional traders, you can call them whales, are looking at buying or are looking at also getting a share of from that market. Now, if you relate it to the traditional system of the market, when you have something which has a fixed supply, all right, you realize that as the demand of that particular item keeps on rising, the prices as well keeps on rising, right? The price keeps on rising. Now, the beauty about this is that as the price of this asset, this item keeps on rising, the people who will be buying at whatever price they buy, and any slight increase in the value or the price of that asset, they will sell it and get some profit, right? Now, as they sell, as they're exiting the market, it's where some people are again picking up from. Whatever they have sold is what they're buying for themselves as well. And probably the same scenario tends to build up. The more they buy, the price keeps on rising. The more they buy, now depending on how much the price is going to rise, when already speculation begins to set in, because that is natural, that is part of life, that when something is beginning to rise and rise and rise and rise, a point is going to come where some fear is going to set in. Some people will begin developing a fear that, you know what, but the price of the thing has really overrisen. I believe anytime soon, the price may drop, right? The price may drop. If it is something, for example, if it is an agricultural produce, that is probably, there is a season, an offset season, and then the peak season. The peak season is where there's really so much in the market, but then the offset season are those periods where the supply is reducing and the demand is high. Now, as people tend towards the peak season, the time when the harvest is already being picked from the fields, and people are planning to begin selling them. That is the point when people, the traders, especially the people who love stocking, begin to see a way of getting rid of whatever they had in store, right? Whatever they had stocked, whatever they had in store, they begin getting rid of it, meaning they're going to sell it back in the market, right? If it is consumable, then people are going to consume them. Now, why are they doing that? Because they're eyeing at the next season where there will be so much surplus of whatever is coming from the fields, right? So that they can buy again at a lower price, store them, and then as the price rises, they probably may be buying and buying and buying and stocking. And then the point is going to reach where they will just not do anything, just keep or hold on those products until the price reaches a certain significant price, and then they do what? And then they sell, and then the cycle continues. Now, if you relate it to the market, I want you to relate it to the market. Most of the times when we're trading, we go blind. We don't understand some of this market psychology. We don't understand the trading psychology. This is literally the same thing. This is literally similar to what happens in the market. Whenever we are buying these assets, all right, we buy them with the aim of making some profits out of them, all right? But we have a fixed supply of these assets. Talk about Solana. We have a fixed supply of Solana coins in the market, and it is the very one that are in circulation that each one of us want to have a hold on. Want a share. Now, if I buy a certain quantity of Solana, and then all of you who are on the call begin buying some quantity of Solana, that means we are reducing their supply from the market, right? It's more like you're buying it, and for as long as you have not released it back, you have not sold it back into the market, you have literally stored it in your own store. In this case, the store will be your wallet, right? So you have your Solana coin. You have your Sol coin, with reference to the sports market, because in the sports market, whatever you buy is actually yours, right? You own it. You only disown it when you release it back to the market, when you sell, right? But whatever you're having in your wallet is literally yours. You put your money on it and it becomes yours. Now, imagine I'm buying and everyone else is buying. That means we're trying to reduce, the circulating supply, the ones which are supposed to be in the market, right? Because we are taking them, we are trying to take custody of them. We are keeping them away, because no one will get mine unless I sell them, right? So that means whatever is going to remain, if they were like 2,000, just for an example purpose, if they were like 2 million Solana coin and I buy 1 million, that means whatever is already in the market available there is only about 1.9, right? Now, and the more people keep on buying, the more whatever is in circulation keeps on reducing. Now, I want us to also know that when we decide to sell them, we increase the surplus in the market. And as we increase the surplus in the market, what we are literally doing is that we are trying to manipulate the price in such a way that we want the price to drop so that we can again buy. Now, as retail traders, really there is little that we can do to influence the market. Okay? But the people who have good money will tend to manipulate the market. Now, it is worse when you go to the futures market, because it is a market literally where the manipulation is so high. Because there you make profit in either direction of the market. So meaning you can decide to accumulate your position with the aim of selling them. Because when you sell them and indeed the market price drops because of the effect of your selling, then you're also going to make profit. Or you can decide to buy more, and the effect of you buying more you're going to reduce the supplies in the market, and then what happens? You are going to boost the price to rise, and you still make profit. So either way, you're going to be making profits for you. So with that in your mind, there's what we call price delivery algorithm, and that is what I want us to share on, to throw some light on tonight. And I hope it becomes beneficial at the end of it. And let's just go and share this. Let me just share my screen, and then let's go here. I hope you guys can see my screen. Yeah. All right. So there is what we call price delivery algorithm. Price delivery algorithm is more of like these are like stages or phases that in the market cycle. Okay. I'm going to let me open. I don't know where am I. All right. So the price delivery algorithm, these are like more of like stages or phases that the market undergo. All right. And it is very important for you to really understand that, because it plays a very key role in you understanding the movement of the market and what happens at what point. Because if you understand that, that means the event that happened yesterday wouldn't, the past 2 days wouldn't be a surprise to you. Okay. So there are about 5 price delivery algorithms, and I'm just going to share something on them. I'll be sharing this slide as well, but then what I'm going to do, I will prefer to let me just use my trading view, because I'll make some demonstration there. Okay. All right, here we are. So there are 5 stages in the price delivery algorithm. The first stage being what we call the accumulation phase. Accumulation phase, just a minute, okay. Accumulation. Now, the accumulation phase, take it that it is a point or a stage, the first stage in which traders are actually trying to hold these positions. In simple terms, just take it that the traders are trying to, just a minute, okay. Oh man, what is this? Okay. Okay. So at this stage, most especially the traders, now we're talking with reference to the smart money. At this phase, what happens most of the times is that the price of this asset will not have a clear direction. It will not have any serious movement that may be very significant or may be impactful in the market. Because at this stage, what will be happening majorly will be that the traders will be accumulating accumulating positions. It will be they will be accumulating positions so that at a later time they can move the price to the intended direction. Okay. Now, in the accumulation phase is a scenario where in most cases, when you go into the chart, we shall see that the price is actually trading only within a very tight range. It will be trading within a very tight range. There will be a price range within which the price will be moving, or price action will be moving. Okay. Now, in most cases, we tend to refer to that as a sideways market situation. So in the accumulation stage, we shall be seeing more of consolidation happening in the market, and it means we shall be experiencing what we call a sideways market situation. Now, what you need to know, what you need to understand this is that what is happening at the accumulation stage is what we call liquidity buildup. The liquidity builds up. Now, let me draw something here. Let me just try to draw something. Let me draw. Let me try to draw this, okay? I'm going to select a price range. Let's assume this is 1. And then we have the second area. So in the accumulation phase of price delivery algorithm, we shall realize that the price will be trading within two price ranges. You realize that the price may try to rise, but it really does not really move past that level, and it comes down. It will not go below this level. It will try to rise slightly, again come back. Probably next time it moves up, try to go down and then stops midway. You know, it's just wandering in between two price ranges, right? So in this case, we shall be saying that the market is undergoing a consolidation phase.
Yeah, sorry guys. I guess we lost him. So he'll join us soon.
Can you guys hear me? Sorry for that. Man.
Yes.
Okay. So I was saying that
Hello, Coach Musa, if you can hear me.
of
Coach Musa,
when
you're back, but unfortunately your audio is very static.
Yes.
You're back, but your audio is very static. So we can't hear you fully. Like you go off for a few seconds. Yeah.
All right. Can you hear me now?
Yeah, we can hear you. Hopefully it's going to be the same all through.
Okay. Thank you. Let me try sharing again. Thanks for that. Please, you do the same in case just something comes up, please. Because okay. I hope I'm clear.
Yes, you are.
All right. Now, what I was saying here, that the intentions of accumulating positions by these whales is either two. I mean, there are two. One, the intention of accumulating position is to dump the market so that they can make profit, or to pump the market so that they can still make profit. Right. Now, depending on the area or the reason the price would be, they will otherwise. Okay. Getting point to realize times price can be eaten. When you're retail traders, at some point you'll get to understand that when the market is ranging, probably it is always not the best moment to make entry decisions in the market. Especially if you're a sports trader, you wouldn't wish to make entry when the market is ranging, because you don't know the direction in which the market is going to take. Same applies when in the futures market. If the market is ranging sometimes if you're not very sure, if there is not any clear direction that the market has taken or is beginning to build up for, don't make entry. Why? Because the market can go in any direction. Because the whales are manipulators. They know what they want, and they want to make profit in whatever direction they want to. They can pump it, they can dump it. Meaning, if you had gone long and they dump the market against you, you're off. If you had gone short and they pump the market against you, that means you're off. You get liquidated. Because for whales, what they're interested in most of the times is they want that money. They want the quantity of coins that you're having hold on. You've bought yours, you've bought your own, right? With the hope that the price should go in your favor. For them, that is what they're hunting for. They have specific goals. They have big money, right? They have a lot of money. Imagine you have only 500k coins in circulation. These whales, in the market, in the market, that is what is available. But these whales wants like 1 million of the coins. That is the position they want, the quantity, the position quantity they want, all right? But what is available is only 500k. Now, what are they going to do? They're going to remain in the market. They're going to be hunting for those very small coins, right? But those, retail traders, the people of $10, the people of $20, $100, they'll be hunting for those people to get rid of, to grab whatever quantity they're having, Remember, you have your $100 and you bought a coin. I was just giving an example, like if you have a Sol coin, a Solana coin, you have your $100, now you've bought some Solana coin, right? Meaning there's a way you're affecting the market. So you have a hold of this $100 worth of Solana coin, but this guy wants 1 million. And what is available only is 500. So the person will buy, the whale will buy the 500, and then we'll begin hunting for the other remaining 500, so that they they move the market to the direction they want to, right? So that is what they have. That is their order. They have created an order of a quantity of coin worth 1 million, but what is available there is only 500. So that means at that point, there's nothing more they can do other than try to wait or hunt out for those ones where they are. And where do they normally find them? On the retail traders or with the retail traders. Okay? And how do they do that? And I'm going to show you how they do that. Now, remember, we're in the range, we are in the accumulation. They're accumulating positions within here. They're still accumulating. You want 1 million, but only 500k is available. So they're going to remain in this area for some time. Okay? They're going to remain in the market for some time as they continue to grab. They continue to grab. Now, sometimes what they would do is, as a retail trader, that once the price breaks above this area or away from the ranging region, it is known to you that the price is most likely going to go bullish, right? It's going to go up. What do you do? You panic. You make entry decisions out of panic. You don't want to miss out. You say, you know what? The market has broken out. It has broken out, right? Oh, it is going to go. If I don't enter now, what is going to happen? I'm going to miss out. It seems the market is ready to go up. Then what do you do? You make entry just above the area, what you would refer to as the resistance level. You see that the resistance has been broken, and you've not even confirmed, but you want to dive in so that you enjoy the ride because you think the break is successful, it has happened. Then what do? Very many retail traders will jump in. That's the first scenario, how they're going to trap you and get rid of whatever you have. The second scenario is the people who know that, especially those who want to go where? Who want to take a short position. There are people who want to take short position and then long position. From what you have been trained is that whenever you want to take a short position, you always make sure that you make your entry around a resistance area. You look out for this price reaction level, what we call the resistance level. Which price has been reacting to 7 such that you wait as the price is going to resistance. You say, let me set an entry area here. So you set your entry or you pound there with the hope of going short, all right? Right? Then, in so doing, for those who love trading with stop losses, if you make your entry around here, possibly you're going to set your stop loss somewhere just above here, right? Yeah, such that in case you make an entry with the hope of the market going down or after being rejected by this price reaction level, you know that you're going to make some profit. But then unfortunately, what happens is that the price comes and breaks slightly above. And if it continues above, you want to cut your loss, right? You want to cut your loss, so you want the system to close your trade. Instead of losing everything, you can afford to lose that percentage, right? Only. You can afford to lose the percentage equivalent to this. I mean, you are okay with losing a quantity or an amount of that will be equivalent to the here stop loss, right? So what you're going to do is this. You're going to say, I love trading with stop loss. Now, this is for people who love trading with stop loss. I love trading with stop loss, so I'm going to make entry here. Then I'll take my profit to this support. That is a short position, right? Just to be safe and cut my loss, if I make entry around there, I'm going to measure like 2%, okay, 3%. Okay, I'll set my stop loss there. Okay, this is where my stop loss is going to be. Then you say, okay, we are good. Set your stop loss there. Okay, so that's where your stop loss is. Okay, 2%. So if you had like 100, 1,000, you have one there, and you do the 1,000 by making an entry this level. You're going, if the market again, instead of me losing the 1,000, for example, I would rather lose what is 2.93% of 1,000. That is around $29.2, right? So instead of losing in the entire 1,000, I would rather cut the loss. Let me lose the $29.2 and I retain the the 100 and what? And 70, what? The one something dollars? Let me retain $970 something and only lose the 29.3. That is cutting your loss, right? Am I right there? Because I'm building up on something. Am I right? Am I right? Right? Am I right? Am I right? Yes, for those who love trading with stop loss, because there are two scenarios here that I'm going to explain. Those who love trading with stop loss, and then those who get trapped with what we call fake breakouts. Right? Right. Okay. Now, the first scenario I said are those who love trading with stop losses. You are trained that when you're trading futures, if you want to take a short position, you should always, okay, there are other strategies that you use, okay? You may tell you know, institutional reference point. These are the institutional reference that in as to either. Now, you may be, if they're based on the support and resistance, they'll say always when you want to take a short position, make entry or set your preset around the resistance level. So you time when the market price is rising as it is approaching your resistance level here, all right? Then you set your preset to go short, right? Now, then just in case, to cut your loss, you may be advised to also use a stop loss. So okay, just measure percentage and stop loss. So the area of resistance, the resistance, you're not only looking at a line, sorry. You're looking at an area. So you have in your mind that, okay, sometimes because it is an area, if I make entry here, this area spans slightly up to around here. So let me set my stop loss around somewhere where the resistance area stops, because it spans through this area. This is an area of resistance. So you allow it some percentages above, because it's it's an area of resistance. So you set your stop loss slightly above your entry point. Now, if you do that, the smart monies understand that very well. They know where to hunt for those where you are hiding those coins. They know, because when you lose the $29.2, that $29.2 is worth certain quantity of coins. For them, they're interested in that quantity of coin to build up on what they were accumulating. Remember, their order was 1 million, but they only had 500 in the market. So they have to hunt for the remaining 500. Am I making sense? Am I making sense? If I'm making sense, let me see a yes on the chat. Making sense. Yeah, are we picking something? Right? All right. Okay. Perfect. Let's go back. So they have an order. Just like you make an order, you want something, but what is available is little. So you say, you know what? Please continue accumulating until me, I want 1 million. That is what will happen here. Now, here, the wells, the smart man is know actually what to do. They know that it is a common practice that most people will trade with stop losses, right? Which is not bad. They know where most of the times they like setting the stop loss. And we're going to have this experience on the chart and we're going to see them, how they fare out. So they know where to hunt them, right? They know where to hunt them, right? So in the price delivery algorithm, apart from the accumulation, there's what we call the manipulation phase. The manipulation phase, or what we call the stop hunt. Some people also call it liquidity grab. Hey. It is called manipulation. If you don't want to call it the manipulation, you may call it a stop hunt. Or you may call it liquidity grab. This is what I'm talking about. Let me just go on my slide and I try and show you. This phase, this is the phase I'm talking about. This is the phase, okay? It's called the stop loss. Now, what characterizes this phase? What happens during this phase? Let's go back and I explain it. During this phase, what the retail traders do, they want
Coach Musa,
quantity,
Coach
right?
Musa, Coach Musa, Coach Musa.
To wait. Yeah.
Your audio, please.
Yes.
Yeah? It's static. It is
Yeah.
static. Your audio is static,
Oh,
yeah?
Oh man, what am I gonna do now? Oh.
We understand
Let
you
me try
can't
to
control
look.
the but just try and
Let me try
see.
to change my location, but my network seems to be okay.
Really sorry.
Man. Okay. Let me just try to locate. I see. This place will be fine. Am I still breaking here?
Let's hear. Proceed, please.
Okay. Let me try. Okay. All right. Right. So, when I'm changing screen, that's when it happens. Okay. Let me now concentrate only on the trading, or could be the weight of the trading view, maybe. You know, the trading view also takes some space and it affects the running of the phone system or memory. So I don't know, it could be. Yeah. Yeah. So okay. Let's move on. Let's just move on. Yeah. Let me share my screen. Okay, let's am I okay? Am I clear now? So let's look at the events that happens. Okay, thank you. Let's look at events that happens within the price will spike outside the accumulation range. The price will accumulate. I mean, will actually spike outside the accumulation range to capture liquidity. Now, at this stage, the stop of retail traders, the stop losses of retail traders will be hunted. End of the direction, either below the support or above the resistance. And then there's what we call a false breakout. So it will create a false breakout effect that is going to trap the traders on the wrong side of the market. And I think, let me explain this. Let me just go on the chart and I try to explain it here. I hope it won't break again now. Oh. Hope I'm not breaking before I continue.
You're fine so far.
Okay, that's better then. Okay, so what happens here is, after traders, after these smart monies, seeing that what is available is below what they want to order for, be below their order, below what they intend to buy, right? Or below what they want to accumulate. They're going to begin hunting out for where some of those money are. All right. So what I was saying is that when the smart money realizes that whatever that, whatever is available that we wanted to accumulate is actually below what they're expecting, they're going to begin looking out for where some of, how to get the remaining balance, right? All right. They're going to begin looking out for where to get them. Now, they're going to begin hunting out. They want to take you out of the market. They want you to give up on the market. They want you to release what you have in store, right? They're interested in the quantity, but of course, remember the quantity of this coin is always worth some dollars, some money, right? That's why you see if you're liquidated, that means you lose the quantity that you had, the coins that you had, including the money, because the quantity of coins you have is actually worth that money. That's when you only focus, I've lost this much. But the smart monies are interested in the quantity of what you're holding, right? So as to fill their order, what they wanted. They wanted 1 million. There was only 500. I'm just relating. I want us to understand it this way, in the simplest way. So what they're going to do, they're going to hunt out. Now, as they're going to begin hunting out on this, what they're doing is they're going to manipulate the market. They're going to give you a deception. They're going to cause a deception on the minds of the retail traders. It already knows what the retail traders tend to do. It knows the retail traders love trading with stop losses. It knows the retail traders ride on their effect, on the effect they cause in the market. They understand that perfectly well. So what they're going to do are two things. One, they're going to begin taking out the traders who love with stop losses. And they know how to hunt these stop losses, by the way. They know how to hunt it. Two, they are going to also set a trap, a deception for those who will be wishing to make entry after the breakout. So they're going to cause what we call a fake breakout. All right. Now, if they wanted the market price to go, if they wanted to take a short position, they want to accumulate certain quantity of this coin and then they dump the markets because they know still they will make profit, right? So they want to dump. So their intention is to accumulate and dump so that they can buy at a later time when the price is lower. That's when they're going to take a long position again. But for you, you'll be frustrated because you no longer wish like trading because you have been liquidated. You don't have money, right? So they want to dump so that the price can drop low and they later buy cheaply again. So if that is their intention, at whatever stage of the market, they're going to cause a deception, a fake breakout. So this is what's going to happen. They're going to, this is the accumulation phase. So what they're going to do is they're going to move the market price in an attempt to go up. And actually, you realize that a bullish candle is going to form. It will build, it will open from below the resistance zone or the resistance area, and it will go and close above the resistance area, right? That is the first breakout sign that they're trying to fake, if that is the intention. Then another, that is the first thing. Now, if your stop loss were within this range, right, where the bullish candle is going to stop, you already taken out. Because the system is going to close you, because you set maybe your stop loss there. You want that if the price goes to that stop loss area, because you're not very sure whether it will continue up, so you rather cut your loss. So the system is going to close the trade. It will retain whatever it is going to retain, okay, as your fund, and whatever has been taken out, you lose that one. Now, they would have taken the quantity of coin equivalent to what you're going to lose, right? That is the first takeout strategy. Now, if this if let me just make this a bold figure, let me put it at 3%, okay? So let's assume that was it. I just want 3%. I'll take 3% only, just for purpose of explanation. I will not look at the 0.7. Now, if that was the case, I gave you a simple scenario that if your intention was to set a stop loss at 3%, just slightly above your entry, because your intention was to go short. And that is the intention of the whales as well, remember? Yeah? You know, sometimes you do this analysis, but then you say, but no, it will be this way. Now you fail to stick to what you had actually made as a decision at first. You say, but no, let me go this way. You see that? And that's how the trap happens. So your intention is to go short. Even the whale's intention is to go short. It doesn't have now accumulated position, so it has to hunt out for the remaining one so that the orders can be filled, and then finally the market goes where? Down, meaning they dump the market. Now, if you hold on to this, maybe you stayed a little longer, at a later time the market will still go in your favor. But because if you do a panic, if you love trading with stop losses, then what you're going to do is you're going to set a stop loss here. So as the price tries to break out above the resistance area, the first people the whales are going to take out, or that the whales are going to grab their liquidity, you know, their money, will be the stop loss traders. It will take you out, right? It will take you out. Now, the next people that the whales are going to take the liquidity, yeah, the oil will take liquidity from, will be those who do what we call panic sell. You panic. You made entry here, but because you did not use a stop loss, now you're seeing the market is going against you. In the fear of not losing out completely, remember you have $1,000, okay? For the stop loss people, they've lost $30 when they were taken out. So the remaining is $970. But at least they've not lost everything. So when you don't use stop loss, what's going to happen? You're going to develop a fear, because probably the market may continue rising against you. Maybe it will go to $30 or even slightly above the $30. And in the fear that maybe at a later time it may go and take all what you had, you're going to sell in panic. As you sell in panic, what have you done? You've released back what you had in store. Boom, back to the market. Who's going to take them? The whales. Remember, they're accumulating position. Now, what happens then? Immediately you sell them. Once their position accumulates what they wanted, you're going to see the market reversing. Again, going to the direction you had initially predicted. That is the psychology. Before we continue, are we making some sense here? Before we continue, are we making some sense here? Hmm? Yeah. Somebody's already asking, how do you know effect breakout? Don't worry. We shall arrive at that. Yeah. We are going to get to that point. Just don't worry. Right? I'm just trying to make it a little simpler. It is a feeling. It's what most of you have experienced, and it is the reality. It is not just an experience, but it is what happens and what will continue happening. So if you fail to take heed you fail to take my advice at a later time, liquidation will be your friend. The whales will always know how to take it from you. They will give you a deception and you'll always fall trap of that. Yeah, you'll fall in for that, right? Okay? Yeah, sometimes the market, reaches the stop loss and doesn't trigger to close the market. Yeah, it doesn't mean it has not reached it. It just came close to it. Because once it really hits it, it will close. That is obvious. Maybe you just missed it narrowly. The position that particular whale or that institution wanted to accumulate was actually filled rightly. That's when you now see the market going back. So that means you just missed it. It was a narrow escape. Don't say it has not been taken out. It is a narrow escape. Yeah. I love this. Yeah. So, yeah, let's go. So, taking out stop loss people. To panic sell. They just see the market against them and say, oh, Charlie, what's happening now? And you close. And the moment you close, you see the market going again in your favor. The previous direction that you had intended the market to go, and that is where it again it goes. But after taking you out, can you imagine how hurting that can be? The market playing with your emotion. This was trying to manipulate you, giving you deceptions, and you fall for it. Crazy. That's why the margin calls become very key. Hey, it becomes very key. It buys time. It buys time. Yeah, you get that? As the whales are also accumulating, you also accumulate from the panic sellers. Okay? As it is going against you, your robot should also be at work. It should also buy a little. As the whales are getting from those who are panic selling, you're also buying a little. As the whales are getting from losses, you'll share of it. Win the game with the whales. But at the end of it all, it will fall in your favor, okay? You just have to be patient. Just play along. Play along, okay? Don't say, oh, I'm going to, no, play along. As long as you had actually managed your capital and risk very well, why not? Play the game. Play along the whales. You will win. The whale will not get you. You will not fall trap of the whales. Those not fall trap is. I am telling you this. You will not. But if you think you know it all, you think you control, I've analyzed this so well. Yes, it is going to go. No matter. Oh, no problem. I love using stop loss. I love you continue using the stop loss. You make entry on this one, you lose $30. You go for another, maybe you're going to set a stop loss, you lose another 20. By the time the day is ending, yes, you're going to lose like 100. Yes, you're going to be deceived. Yeah, maybe there's a trade you're going to really get a chance and really make $100. Then you're going to get excited, thinking you made money. Yet not forgetting you lost 100 before because of the stop losses. Now you're making 100 and you're excited. Are you sure? Are you doing something? Or you're just going like this? Yeah, for you, you're just going like this. You're going like this in cycle. You get very happy. You lose, and then you make back whatever you lost. Then you're happy. Oh, I made $100, but you're going in cycle. Are we having some experience here? Are we having some experience? Am I speaking some people's experience? Oh my. You get very excited. You very excited, and you think you've made money. Eh? You lost 200, yes, 200, and you are very excited. Oh, I made it. You are not retaining. Retention is in trading, in futures trading. Retention is no. It is key. Yeah? Try, and do retention. And then the other bad thing is, don't do revenge trading. Maybe shall talk about that later at some other day. Revenge trading. You've lost dinner. Let me go again. You lose it. Let me go again. Now the market is playing with your psychology. The whales are playing about. Remember, for them, the whales, they have a quantity they need. Now, they're going to give you deception. Use the stop loss clauses. Then you say, let me go again. Maybe now it will go. Then again, you see it going up. Again, stop loss is hit. Oh, okay, let me go again. Because you are stubborn. Because you think you're going to do revenge trading. And the issues with you think this time, now let me go. You lose the big one. You lose even that big one. I'm telling you. Me, I don't trade with stop loss, honestly. Yeah, I'm not preaching against it, or mine is just to share knowledge. I don't preach against anything. Please, stop loss users, use it, but I'm just opening your eyes if you can. But if you can also maintain your eyes closed, it is okay. Yeah? As long as you're able to move, as long as you're able to predict the direction you're going, it is okay. You can still move with the stop loss still. I'm not against it, honestly. I am not. I'm just trying to share what I know. I'm sharing what you must know. That's all. Okay? I'm not preaching. I'm not preaching against stop loss. So, all right? I'm just trying to share what I can. So let's come back. So we already know the second phase, that the manipulation for the key traders. Okay? Retail traders especially. The market moves, boom. So in the manipulate smart money was they grab the liquidity after hunting for those who love trading with stop losses, and then those who do panic sell. To grab is key trader. To do panic sell. Yeah, you're giving, it becomes like the fuel. And then what would have happened? They wouldn't believe what they want. So they will see it them into the next phase of the they're ready to move. They will be ready to go. Okay? So manipulation is an experience that you understand, and then because that's tend to mislead, it will get them on the wrong side of the, especially those who don't understand the aspect of breakout. A breakout, it is very important. A bullish breakout happens when a green candle open. If this is the, let me just delete this. If this is the resistance line, right? Let me just say a resistance line, right? This is the resistance line. So a bullish breakout happens in this way. You will have a green candle opening from below the resistance line and closing above the resistance line. Then the next candle that should open, which should probably help you confirm, though sometimes you can make a confirmation through the third, but for you to really be certain, the next candle that is going to open should open from above the resistance and still close above the resistance. That should, any candle going to open and close above that resistance after the breakout candle should help you at least to some degree confirm that it isn't a fake breakout. A fake breakout happens when the first candle opens below and closes above, then the next candle opens from above and comes and closes below the resistance. This is a fake breakout. But a good below close green candle, it will open, it will close above. All right. And if the next one probably is coming to the
Your network is breaking.
Yeah?
We can't hear you, coach. Your network is breaking.
Can you hear me now?
Yes, we can hear you, coach.
Can you hear me now? Am I?
Yes, we can hear you, coach.
Okay, thank you. Yeah, you guys should always inform me. If you don't inform me, really, it may be hard. Some of the things are beyond my control, you know. And just okay. We're good? We're good to go? All right. Maybe but sometimes when I'm acting, is it just that it doesn't want me to
You're still
okay.
static.
Maybe
You're still static. I think maybe we can try and bear if you don't have a choice.
Zoom ready. Is it still breaking? Oh man, what do we do?
Yeah, yes. It's still breaking. I don't know. That time you're so okay. Then there are times you just like really off.
Yeah. How about here?
We can try that.
Okay. You see, the challenge with me, okay, I don't know, maybe, but in my end, I always love using Google Meet at least. Google Meet does not really so much disturb. Zoom tend to disturb, especially my network, because you know Zoom app it's a heavy, and then when you're in a trading, it's also a heavy app. So I don't know. There's a way it tries to disturb my network. I don't know whether it is the speed that is affected, the phone speed. So it tends to really disturb, but I don't experience it often when I'm using the Google Meet app. So I don't know. But you will bear with me. As long as you're able to pick something, it is well. Okay. Just keep on informing me so that I always see how to. The trading view is a heavy app. I don't know whether some of you have experienced it as well, especially if you have you've created multiple watch lists. It becomes heavy. You get that? It becomes a little heavy because I have like multiple watch lists. I've categorized my coins in certain ways, so I've created over about close to 8 to 9 watch lists. So it tends. Yeah. All right, let's try it one more time. Maybe let's go and see. That means if I'm on TradingView, I need not to move out of it, because if I move out of it, next time it has to come and reload, and that is what is going to cause the break in the network. So let's see. I hope you're good. We're still okay. Hope here it is fair.
Yeah, it is.
Okay. All right. So let me come back here. All right. So I hope we understood. We actually understood the first two phases of the accumulation. I just related it. I just made it simple so that you really understand the concept of what happens in the market cycle, and how we always get privilege of riding on the smart money's back, but at the same time we also get snap back. We are hit seriously at the back by the very same people we look up to. So we need to understand the concept pretty well to give you every kind of reason to always, when trading, to manage your risk and wallet well. And two, with the objective of retaining other than losing. And also with the aim of ensuring that you take advantage. You always play the game with the smart money. Try to play along. And that will only be effective if you really use the margin calls. Try so much to use them, okay? And allocate the fund in a way that you won't so much be affected, okay, by the liquidation. Because at the end of it all, even when you're trading with these margin calls, what you must put at the back of your mind is the more you risk, right, the more the chances of liquidation, especially if you don't have enough backup capital, what we'll normally refer to as the margin, the maintenance margin. But if you risk more and then you have enough backup capital, you still stand out to be safer, okay? Because even the more the bot buys the margin call also at the same time, also, that means you're exposing more in the market. That means also the risk of liquidation is also approaching or is increasing. So that means it will require you having enough backup capital. So if you do proper wallet management, with proper risk management, trust me, you'll always good. And I must say this, and I'm not bragging. And even if I'll show you for those who get a chance, I can share them with them my own experience of liquidation. If there is liquidation that I've experienced with Royal Q in the futures market, it is not more than 5 times. And I would challenge anyone to, I give you my board and check through. It's not more than 5 times throughout the time I've traded futures. Now, not that, because I don't say that I'm not liquid, I have also experienced liquidation, but not more than 5 times. Okay. Now, that always happened. Why? Because at later, I came to realize some of the things that it's not about how much you're making, but how much you're retaining. And it's about portfolio build-up. It'd rather be slow, steady, but progressive. Okay? That is what I've discovered. So it's really very important for us to understand that. And if you do, then I think we can have a successful journey. Right. So coming back here, we have the 2 phases, I believe, understood. So about this indices of breakout, we have fake breakout and true breakout. True breakout, as I said, is a scenario where a bullish candle opens from below a resistance line or area and then closes above it. Then the next candle that is going to open should open and close above. And probably the third one should do the same. That one should give you a confirmation that is a successful breakout. Then the price will go a little bit up and later come and revisit the point broken. That is what we call a true breakout. And that gives you what we call a trend breakout. And it sets you into the next phase of price delivery algorithm, which we are calling the expansion. Remember, we said once these whales of smart monies take out, grab enough liquidity from the markets. Whenever they, grab this liquidity, they get rid of these stop loss traders, those panic sellers, and they have accumulated a sufficient order. Then now the price is going to deliver. It is going to now expand. It will now continue up. All right. So there's in the third phase of price delivery algorithm, which we are calling the expansion. Okay, expansion. In this scenario, what happens really is that, let alone the trap. Here now, the price really comes, and it can happen in any direction. The expansion can happen in any direction, depending on the intention of the smart money. So if they accumulate enough position, they can decide to move the market off the accumulation zone or below the accumulation zone. The most important thing, they should get out of there because their orders have been filled up. So it has to now move to the intended direction. So it can go down, meaning it can break below, or it can break above. Okay? We shall say that the price has set through the expansion phase. Okay? So what happens normally within the expansion state, the expansion phase? Now, what is true about the expansion stage is that this is where the real directional move begins. Okay? So once liquidity has been taken from the market, the real direction sets in, or what we refer to as a trend. That is a build-up of a trend. So if a breakout happens and the market and the price leaves the accumulation zone or the consolidation area, and it goes above, it breaks above, we shall be setting through what we call an uptrend, right? You get that? We shall go through what we call the uptrend. However, you know, and this is the phase where, for us, we get excited about. Though sometimes some of us don't know how to go about it because we get trapped, just like I was explaining. We get trapped. We think it is a breakout, yet it is actually a fake breakout. It's a trap. It's a deception. So you fall for it, and then you find yourself on the other side of the trade, the market going against you again. You see that? So, but if there is a clear breakout like this, and the market has expanded, then this is where now the retail traders can now think about jumping in, because there is an established trend building up already. Okay, there's an establishment of a trend trying to form. So you can ride through, right? You can ride through. You get that? But then also at the same time, within this zone, or within this phase, you must also understand that most of the times there is bound to have what we call an imbalances in the market. The market is most likely going to experience imbalances. Now, the imbalances in the market, literally, based on the smart money concept, if you've ever gone through the smart money concept, these are like sort of like, because let me just relate it to this. You know, a scenario. Yesterday, I was trying to explain the same thing when I was doing some one-on-one mentorship. So what happens most of the times is when an imbalance is being created, and take an imbalance like you know, you're hungry, right? You're very hungry, and then let me just not relate it to you. Let me relate to an animal that is hungry. Let's say maybe chicken. And then it stayed probably the whole half of the day without testing anything, and then you bring the feeds and pour. Now take it that the chicken are going to begin feeding as if the feeds are going to get done, you know, quickly. So they would begin even stepping on others. They eat here. They're not going to take it systematically, right? They're not going to take it in order. They're going to jump, eat here, peck here, peck there, like you leave other feeds behind, right? Leaving other feeds behind. Now, as it is pecking and moving, when whatever is in front is done, that's when it comes back and begin pecking the ones that it left along the way. Now, an imbalance is like in that scenario. An imbalance refers to those phases, those scenarios, those situations where some liquidity are going to be left behind, right? Remember, the momentum has already been built. The wells, some of these smart monies orders have already been filled. Now the market is going. It's now, let's take it as a bullish movement now. The market is now moving. The price is rising significantly. So much momentum. A lot of volatility now there. And so many traders are excited. Retail traders are excited. They're all jumping in and they want to take a share of what is building up in the market. Then some liquidity are going to be left behind. Now, those liquidity that are left behind, you know, we in smart money concept, they are called institutional reference points. You'll have like the fair value gap. An imbalance is going to be created, which at a later time, after the price expanding to certain level, the smart money will have to come back and collect those liquidity, right? Whatever was left in the market, all right? So the expansion stage is actually the event that happened. Then once the price expands, what is going to happen at a later time? The price is going to come back. Sorry, what is this? What's wrong with my, okay, let me get another. The price will expand, and then up to some level, because of the imbalances created in the market, the price is gonna come back at a later time. Now, this other stage where the price is coming back at a later time to revisit, to pick, to repack the left out foods in that process of vigorous, hunger So those things that left behind, the leftovers, is where now the whales will be coming back to collect those liquidity, right? Those to create what we call to create a balance. What we tend to so much commonly refer to them as finding market stability. Correction, we are trying to correct the market. We're trying to create stability. After a serious dump or a serious pump, the market undergoes a phase of correction. Most of the times people refer to that, but that is actually what we call a retracement, a repricing, or a return to some of those institutional reference points to try, like the fair value gap, to try to create a balance. Some of the inefficiency left in the market have to, be made efficient, and trying to just create a scenario of stability in the market. I believe you've ever experienced that when the market over pumps or over dumps, immediately correction happens. Yeah. So that phase is what we call the retracement. Okay. So after expansion, the price will have to retrace to rebalance the inefficiencies in the market. Okay. So by revisiting some of those, what I've just told you, revisit and then picking some of the liquidity left. Now here is another stage where some of the traders, if some smart money did not make entry earlier on, for them that is where they begin setting where to enter from. They begin looking out for those areas to make entry. They establish their entry after a breakout. After expansion. They wait for the price to come back as it is coming back to revisit those areas where imbalances were created. So they set their entry around those areas. And same applies to, for retail traders, this correction, this retracement, to them, to some, may seem like a reversal. Now, and it is a scenario where you find most traders, once they see the market price coming down, they think it is a reversal. So they would want to take a short position. Before they know it, it is actually a retracement. Then, as the smart monies are trying to make entry as the market price is pulling back to continue the trend upward here in this manner, for them, they are looking at it as a retracement. And what happens? They are going to be taken out again. They're going to be taken out again. So this retracement is an attempt to build momentum for the price, for the market price to continue rising. So it has to come back, grab liquidity, build momentum, boom, and continue. And that is where you'll see continuous break of structure, because the trend is continuing to go up. All right. So this is a phase that you have to understand, that when you see a pullback, it is key. That's why when we're looking at sometimes back, I believe with the other traders, leaders as well, when we're looking at some of the indicators that you can actually base on to try to establish trade entry opportunities, like the Fibonacci, we said that most of the times the market price, after expanding by certain percentage, probably 100, it has to retrace, and the retracement or the pullback normally happens within 3 key fib levels, what we are calling the golden ratios. There's a golden ratio fib level. There's 3 key fib levels to which the market price tends to reverse to, and we said they are either the 38.2 or the 50 or the 68. So it's within the 3 key fib levels where the price tends to pull back. And that is where most traders, again, look out for a buy opportunity, because after the retracement, the market is going to continue going up. All right. So that is what we look at when we're looking at some of those indicators. I believe you are well aware now with them and conversant with them now. So that is actually the events that happen. So should this continue, you realize that you have a continuous buildup of that kind of movement, that after this level, okay, the price is going to break that zone. It will expand past that zone, and the movement probably will be by 100%. Then you'll have to again retrace back to this area and then break structure and continue up. Retrace and continue. So this will continue for as long as the momentum is still high. But the moment we see the momentum beginning to reduce, then that is when we now say the price has reached the last stage of the delivery. That is the distribution phase, a point where now most traders, the smart money, are beginning to take off some profit from the market. All right. So the price will reach those target zones, and most of the times in higher time frame, you'll find that for them they set those exit points based on higher time frame. So once the price goes to those levels and they see that there's a significant rise in the market price percentages, then they will begin taking off profits. They will begin selling. And that is where you're going to begin seeing the volatility slowing down, the buying pressure going down. And then what is setting in is actually more of the selling pressure. That is in case it was an uptrend, right? You'll see more of the selling pressure now trying to build up. And then in that regard, you'll begin seeing a restart of the previous cycle. Again, there will be a key accumulation, then there will be an expansion, then accumulation, then manipulation, then expansion and retracement, and boom, you'll have a reverse of the trend. So basically, if you understand that this is just a simple picture, and in the most simplified way for you to appreciate what happens in the market, that as you're going to be trading, you need to put that at the back of your mind. Now, those are the things that happen. Now, it may seem something so big, something undoable, something too much, but it is not. It is not. It is really not. It is so helpful and it is so powerful. It will help a great deal. All right? So this event happens in the buildup of an uptrend. It happens equally in the buildup of a downtrend. The same movement we're seeing here also happens when the smart money finally decides to move the market to the downside after the accumulation phase. The same movement happens. Okay. So is it okay? Is it okay up to that point? Is it okay for everyone? Because I think that was too much. maybe it was too much. Maybe it was too much, but yeah. Okay. I think we are good since I know you've been affected by network. Yeah. I think some people tend to mistake me and Coach Mo. Sometimes some people calling me Coach Mo. Okay, my common names, Coach Musa. What are the names I've been known with in the community since 2021 has actually been Coach Musa, and is the only one I believe in the community. I don't know, maybe unless there's another. So it's Coach Musa. Yeah, it's Coach Musa. Coach Mo is also Coach Mo. Coach Mo pure. Yeah. So people should not always mistake this. We are different great leaders, I believe. So yeah. But anyway, but that is basically the picture of what I felt I should first share with you. I know I've not done all. Network has been disturbing, and for me, I always get discouraged when network is okay. Not discouraged, but it kills the vibe when the network is over disturbing. So, but at least I believe from what I've shared, what you should pick from is whenever you're going to be making entry, okay, whenever you'll be trading in the futures market, observe the following. One, make sure. Let me just list them. Let me even share something. Let me just let me know use what is going to. Okay, I want something. Okay, number one, if you want to effectively trade in the futures market, the first thing you should do is, let me look for my writing annotation. I don't know where it is again. Is it? Oh, it's here. Okay. All right. Number one, what you should do is one, have a goal. When you start your day, have in mind how much are you willing or how much do you want to make on that day. Right? Don't overhype. Don't overhype. You can't tell what the day would be like, especially with regards to the market. Just don't overhype. I'm going to take an example of someone with $1,000, right? How much do you want to make today? You woke up already in the morning. How much do you want to make? So have a goal, have a target, okay? Say, for example, it's $50. That is the target, right? That's the target for what you want to make. So in the $50 you want to make, how many trades do you want to run? Like how many trades do you yearn for, or do you look forward to running for the 50? Is it one? Is it two? Is it three? If it is one, that means you should have to decide, is it going to be one, or is it going to be 5 trades where you're taking only 1%, or where you're taking 1.5? Have it in mind, right? Now, if it is one trade and you want $50, then have it at the back of your mind, okay, I'm going to take one trade. My intention is to get 5%. So what I'm going to do, I know it may close the trade earlier, or it may take some time. I'm not going to rush. I'm not under any pressure. So let me set my trade, $1,000. All right, and let it stay for as long as it wishes to. But at the end of it all, my TP will be 5%. The 5% gives me $50 of my $1,000. That is enough for me. If it closes early, good. If it doesn't close early, maybe it closes by the end of the day, it's fine. That was my target. All right, that's the first thing you should just have at the back of your mind. Then two, with the target set, with the number of trades you're going to execute in the course of the day. If it goes past that, it's fine. But first set, just minimum number of trades you want to trade. Because not all the time the market is good. And whenever you go into the market and you realize that the market is not good, relax. It is not a do or die. It's not a do or die. It's not like if you have not traded, that is, you are gone, you're dead. No. What we have at the back of your mind sometimes drives us into some of this trap. You think you should just trade. No matter, you just want to trade. No. Trade really if you have to, or if you must trade. Not because people are trading, not because you're seeing signal dropped in the group. Trade, follow your target, and go. So after that, having a set goal, tentatively the number of trades you want to trade to make the $50. If your target is $50, trust me, even when the market price just rises by 0.5, that is $5 of the of the $1,000, you're going to close that trade. You're going to close it. You get that? You're going to close it. Right? You're going to close it. Your target is 50. You're not under any pressure. You're going to close it. So when you close it, cumulatively, $5, $5. I'm just giving an example, $5. Oof. You have 10 trades. That is $50. Isn't your target hit? Then you get out of the market. You forget the market at that time. Once your target is hit, first forget the market. If you woke up in the morning and by now you've already made the $50, forget the market for now. Go and do other things. Maybe go and learn if you have some learning session, or if you have some mentor session. Go and have those one-on-one, or go and have those mentorship class. Go and read books. Go and do some other stuff. Your 50 is done. You can come back later when you have the peace of mind, when you're not under any influence, when you're not under any pressure, when you're not then you see if you can make any extra. But you know that the target for the day is done. Don't persist. Don't insist. Don't say do or die. Today, the market is good. I'm going to remain here. The 50 is going to be taken back. It's going to go back. The third thing you should do, have a wallet management strategy. Have a wallet management strategy, because remember, your goal is to retain, not to lose. Whatever you have made, retain it. In fact, for me, sometimes what I do, whatever I've made in the market, I always withdraw and put in something tangible. Anyway, that's me. I'm just giving an example experience. If I had something in my hand, I pick it. That if it is $50, that dollar is not going to remain there. I pick it and put it on something, invest it, use it for something. Yeah. Or I just withdraw it. It remains in cash. Let it be in my mobile money as I wait to accumulate to do whatever I want to do with. I don't retain it there unless if my goal was to build, to grow the capital, maybe to some percentage or to some number or amount. That's when I'll retain it there. Maybe if I wanted to raise it maybe to 2,000 and I have 1,000, I'll retain it there. But if the goal is just to make from the 1,000, I'm not gonna what? I'm not gonna leave it there. Whatever I've made is mine. Yeah, whatever I've made is mine. So I have to put it onto use. All right. So that's what you should. So do that. So have a wallet management strategy. Out of the 1,000, remember the first one is a goal. The second one is if you hit your target, go and do other things. Be away from the market. The third one, have a wallet management strategy. Out of 1,000, if you feel you're not so good, you're not yet there into, you have not understood so much about the futures trading, you don't have enough knowledge there, what you should do is divide your capital. Even when you have it by then, divide your capital. Have 500. Pick 500, transfer onto the futures account, the futures wallet. The 500 should remain either in the spots or in the funding account. Calculate your leverage based on the 500 that you transferred in the futures account, right? Let all your tradings be within the 500. Now, even out of the 500, you're going to calculate what we call the initial margin. The initial margin in this case will be like your first buying amount, right? Which you would want to risk in the market. The 500 is not what you're risking in the market. The initial margin is. So you calculate the percentage which you want to first start with risking. And then at the end of it all, through the multiple buying ratios, you're going to establish how much of the 500 you're going to be risking in the market. Maybe $250 out of the 500 will go into the market. But if you use, for example, leverage of for example, 10x, that means that will be close to 2,500. 250 with 10x will be equivalent to 2,500. Then you have 2,500 remaining in your futures account as a maintenance balance. But remember, you also have some extra 500, which if you transfer to the futures account with your 10x leverage, that is equivalent to 5,000. 5,000 plus 2,500, that is close to 7,500 maintenance margin. Man, how on earth are you going to be liquidated that fast or soon? How are you going to lose that? How? Okay. So have a wallet management strategy that keeps you safe. That keeps you safe. Don't be greedy. All right. So if you have that wallet management strategy, that means you also have a risk management strategy. Wow. I said $500 from within which you're going to base on to calculate your leverage multiple. I mean, right? If you go for 10x leverage multiple, that means 10x of 500 is 5,000. Now, out of the 5,000 that you have been given, determine the percentage of your initial margin. Determine your first buying amount, right? Which is the initial margin. Then out of that, how much more are you willing to risk? Now, that one takes you to the multiple buying ratios on the board. You're going to calculate accordingly. Make sure, if it is possible, just have a half of it. Let the multiple buying ratio fit within a half of the 500. So how the robot is going to execute the buy order, it depends on how you're going to set the multiple buying ratio. Then have 250 remaining and use fast to a scenario where you're not allowing, maybe you're not going to allow the robot to buy anymore after taking half into the market. That means you've already risked $250 in the market. You can retain the 250. Then plus extra 500, which you're going to transfer later on to add up on your maintenance margin to keep you so safe from liquidation, to make sure that your market price does not even go any closer to the liquidation price. There, you can even go and chill and relax. All right? With good spacing of the margin call drops, you can go and relax. So have the wallet management strategy, have the risk management strategy. Lastly, when you're trading in the futures market, understand some of this concept, this psychologies of trading, especially for that person who does not entirely depend on signal. If you wanna, and the best is, I encourage, please learn to see, to go and look at the market yourself. Try to learn, honestly. I'm not just about try, learn. Don't just be on the recipient end. Don't just be on the receiving end. Don't just be in the bandwagoning side. Just follow. Whatever is dropping, you just want to make money. That is what matters. You are not interested in learning. You're not interested in adding value to yourself or into your trading journey or experience. You just signal. Hey, no signal. Who is not dropping signal? Hey, we are not seeing signal. And when the signal is dropped and then probably the market tries to go against you, complain. Oh, yes, sir. A leader. How about this one? But is it going to? I often got very many people who come, Oh, I'm not. Then before they know, oh, leader, it has sold. Oof. Oof, it has sold. What I always tell them, I tell them, you know what? I always tell them, you people, why would you be on pressure? Why the pressure? Why are you always on pressure? Why? They really come, and before maybe after like 30 minutes, oh, it has finally sold. That means for me, even when I share this signal, ladies and gentlemen, what you must know is I put in a lot. I put in this concept, and I believe the same applies to all the signal providers. These are the things they have in mind. They know most likely the drop that is most likely may happen in the market, right? Because it knows that the smart money is also not sleeping. They are hunting out for something from you. So if you fall victims all the time, that's when you lose. But have some concept, have something, have some idea. All right. So when I drop this signal, I know what I base on to drop these signals. And for those who always trade my signal, I believe if you follow what I tell you, you'll always win. You will win. But if you do contrary, you add in your own flavor and if you don't know what you're doing, then you don't inbox me. You take accountability or responsibility for that. You get that? Yeah. So basically, that is a little bit of an insight on what you're supposed to do as a trader, especially you going into the futures. Now, the last bit is, to me, I'm not discouraging anyone into futures, but if you find yourself having, let's say 2K capital, my friend, I would tell you, you relax on futures a little bit. You go to spots. If you want to make consistent, non-pressure results, go to the spots. Just look, design strategy. It still goes back to the learning. Have some strategy that will allow you make money consistently, but with peace of mind. The futures market, why people sometimes go for, which very, very many people may not tell you, apart with the exception of whales maybe, and people with good capital, money, and they understand the strategy, they understand the market. But most of the people, these retail traders, why they go to the futures market is to go and try to build up their capital, right? I mean, at least a little bit faster. Because if you have like 100 and you go, for example, a 5x leverage, that's close to $500. With your good wallet management strategy and risk management strategy, you can increase the 100 to the 500, right? Within a very short period of time. At least you're looking at growing your capital. Now, if you've grown your capital to about 2K, come on. and you really feel unsafe, and maybe you get liquidated so often, first come back. First come back, come home, come back home, come back to the spots, try to do some sports, then learn. As you learn more onto the hidden things in the futures, it will not prevent you from taking some portion, just maybe 100 for learning purposes, or $100, 50. Just you experiment as you design your own strategy of winning it better. Then you can later on go back. But if you have to, begin from sports, begin from home. Charity begins from home. Start from home, build your portfolio. Yeah, do features just for, by the way, right? Just for, as you also learn, as you get liquidated, as you get hit, you also winning, they also win you, yeah, you learn, but you won't have so much to lose because you have enough and more into the spots, which is helping you to generate consistent profit with good settings. That's my advice for the day, and that's what I'm going to leave you with for the days. But most of all, please learn. Learn. You may not be so much dependent on always on the signals. Suppose the signal people are not there. Suppose I am not there. Suppose any other person is not there. How are you going to traverse your journey? So learn. Really, learn. Learn. Okay? Try to learn. Put time for yourself. Learn. Put resources on yourself. Learn. That way, you'll be better. In a few months or in a few years' time, you'll be good. We want you guys also to begin running these classes like we do, to begin sharing your ideas, to begin coming up with strategies that you can as well share, even with us. We may not be so perfect also, but we share what works for us, which we feel you should take a lift from or borrow from, and also try to redefine it or refine it for yourself. As long as it works for you, then that is good. Okay? All right. So some of us have learned this, but it wasn't a one-day thing. It was some time. So by the time we share, that means it really worked and it is really good. So you can as well do the same. Okay? Yeah, you can as well do the same. Let it not be that, all year around you're just in attending Zoom, but you're not making any difference. That will not be nice. Okay? All right. So thank you so much, guys. Thank you for giving me an audience. Thank you for being part of this call. I'm always humbled to share the little. I call it little. I am always happy to share the little I know, the little I have, the little I always use to make sure that I also win in the space, and then to make sure we're good. So thank you so much, Leader Mopiwa. Thank you so much, Leader Emmanuel. I think we have some call after this, right? And see you guys tomorrow, God's willing, inshallah. Go and practice, go and try to assess the market, try to, monitor the market. It's unfortunate I've not taken you through the trading view. Maybe tomorrow we shall go and try to relate whatever I've shared today in real time on the chart and see what always happen. How do the whales trap? How do the smart money trap us, the retail traders? How do they manipulate the market? Just like that. How does the market pump, dump, correct, and like something like that? So we're going to see that tomorrow, God wills, and then we'll see how we can progress. So that's why I said probably this week you may have a different approach, but all I believe will be helpful to set you in the right path. So thank you very much. For those who missed the class, and probably those who may want to recommend, the link will be shared. The Zoom link, not the Zoom link, but the YouTube link to that, to the recordings probably will be shared, and then you can have time and go and check through. Thank you so much. Unfortunately, you'll not find this in my own YouTube channel. Right? I don't really record so much, but if you want it, you can go there. In my own YouTube channel, there are just small, short videos, just to give a little highlight that I believe can also be beneficial. So thank you so much, Coach Mopiwa. Thank you so much, Brother Emmanuel. And Royce. Royce has been good. I love you, Royce, I mean. You've been giving me good feedback, especially if I go off. So thank you so much. And,
although there are some questions not answered, coach, there's some questions you've not answered, and I feel people may feel like you left them out. They are probably around 3 or 4.
Where? Which one?
Can I read them
Let
for
me
you?
let me scroll. Okay. Let me scroll. Let me see.
Some are a little bit too far. Allow me to read them for you. There is one who was asking why sometimes the market, it reaches a stop loss, but it does not trigger a close. So just wondering why doesn't it just close immediately? It reaches a stop loss but continues.
It goes past the stop loss.
Yeah, it does not trigger.
Sure.
Yeah,
with the
somebody
bot?
just on.
With RoyalQ?
I don't know. It just reads. Let me read it out for you. Why sometimes the
Yeah, I
market
gotta
reaches.
understand. I want to understand because whether the person is using it is doing it on the exchange directly or on the using the RoyalQ bot, because these are different things. How
Okay,
you use the stop loss is different. Yeah.
For that, we may not know. Maybe we can skip to the other question. Another person was asking, is it okay to trade features in cycle mode if you have already put in?
And that is suicidal. Me as a person, I will not recommend. That's suicidal. Hey, who can even think of? Man, don't try. Don't, because why? Why I would not recommend is oh man, this guy. Well, not that it cannot happen, but man, that would be suicidal, because I imagine that you are trading, you are taking a short position, right? And your trades is in a cycle mode. So for you, you're only profiting from when the market goes down, right? So if it tries to correct or rise a little bit, maybe the bot buys, right? When it goes down, it sells, you make money, then it buys. Now imagine buying along the dip, then the market reverses. Will you be safe?
Certainly no.
Will you be safe?
Not at all.
Not at all. Though, to some extent, there's what we call what? There's what we call, but it is on the exchange again. It's called, how is it called? There is a fixed stop loss, then there is a flexible stop loss. I would call it like that. A flexible stop loss, for it tracks the movement of the market. It goes along. Maybe I'll explain more tomorrow. But it goes along, right? A fixed stop loss is remains static. Whenever the price comes and hits it, the system closes your trade, and that is all. But with the other one, the flexible, it moves along. I'm forgetting this terminology, how it is called, but it moves along with the trade. If it was at as long as you are still floating in profit, right? For it can go along with you, it carries along. Because for it, what it does is it is aiming at making sure it closes your trade to the maximum profit. You get that? To the maximum profit. So as you are going into floating profit, it goes along. So when the market finally begins coming against you, whatever floating profit you are in, once it drops down by the percentage, which is the difference between the market price and that stop loss you established, then it is going to close. So that is more like a system, the way the robot works. When you're using when you allow the callback, the profit callback on with some figure. The price, the bot will monitor the price rise, okay? And it will not sell for as long as it is still rising. But when the callback is by that percentage of set in the bot, that's when it is going to close. So that's also how the other system of the stop loss work. But maybe I don't know if it is relevant, though, but maybe if it is really important, I will share tomorrow. But it's literally similar to the way the profit callback works in RoyalQ. Yeah. I hope I've answered. I don't know.
Thank you. The person has had the answer.
It's called a trailing stop loss here. Thank you so much, Mukisha. Yeah, it is called a trailing stop loss. For it monitors. It monitors the market movement and make sure it closes your profit. It closes your profit at maximum profit. Yeah. Thank you so much. I think if there's nothing new.
The very last one, Coach Musa. People were asking if you could share your recommended strategies in the group. But I feel if they check the YouTube channel, they'll find all those that you've shared with us. Maybe if they go through, they'll find the strategies that you've taught us before.
Yeah. Okay, for me, the only bit that is with me, apart from short video recordings, guiding videos that I've shared in person in my YouTube channel, most of the Zoom recording, most of the Zoom classes I conduct personally, I don't record them. I don't record them. But I just, with exception of a few sessions that I can record specific parts that I feel may be important. Even when I record them, uploading them, they also take a lot of MBs. I need to upload them. So I only pick a portion and then share. And they're there. There are quite a number of them on my personal YouTube. It's called the Smart Traders Academy. You can find those educational video there, or those guiding video. But if you want the entire Zoom class for the lessons that I've conducted personally, it's on the Royal Q Revolution group. YouTube channel, I think. You can look out for those sessions where I am in, and then you can try to see them.
Yeah, they're there.
And about the strategy, I don't know what you mean by a strategy. What do you mean? Which question? What was the question trying to direct me to?
Okay, allow me to read it out for you. Coach Musa, could you please share your recommended strategy settings in the group? Maybe then when you're free.
The settings. There's a video I shared, especially
Yeah.
for those who are trading futures. I shared some videos sometimes back on how you should set your boat when you are, with some good explanation, with some few explanation though, some small explanation, how you should set your boat when you're trading futures, especially when you're following the Smart Traders signal. I shared that. Maybe I will have to reshare again. You know that the problem is some people don't like when some of the things are shared in the group. Some people don't take them serious. That takes us to takes me back to people just want to make money. They don't know how. They don't want to learn. They don't want something new. They're interested in how do I just make money. That's what they're interested in. So that's why they sometimes ignore some of this video. Even I'm sure when this link is shared in the group, the YouTube link for today's session, still very many will not do what? Will not watch. So meaning that the very people who are going to come later on or some other day when some other leaders are on to again, ask a question related to the areas we have covered. So that's the challenge. But it's okay.
It's fine.
All right.
So
have a good
sorry. So for those people who wanted a recorded version and they also want to find out the settings they're asking about, they can go to the Revolution group. Then they can scroll through. They'll be able to find all those videos showing the trade settings and all that they're looking for. Even for this one, it has been recorded. It shall be dropped in the group. But when you go to the Revolution group, you can click on the notify me button so that whenever we drop a video, you'll be able to find it. That will be all from me. Thank you very much, Coach Musa, and the rest of the leaders in the.
You're welcome. There are a number of settings, video settings there. The trade settings that are there. But specifically for if you follow the Smart Trader signal, you'll find it on the other YouTube channel I've told you. That is specifically for that one only. But the rest of the other settings, you can find them on the Revolution group. YouTube channel. So thank you so much. Have a blessed day. Hey, Brother Emmanuel, anything before we call it a day? Okay, if not, then let's end there. Brother Emmanuel, let's end there for today and have a good day.